Tensions clearly are escalating on an underway trade spat between the U.S. and China. Well, President Trump yesterday actually signed an executive memorandum that would implement tariffs to the tune of $60 billion in imports from China. Of course, in response to this, China has unveiled a list of more than 100 U.S. products as potential retaliation targets. Most steel counters across Asia are trading very weak this morning, and the safe haven yen has firmed up on back of trade-related jitters in the market. Hugh Papert, Chief Investment Strategist of Capital Link International, now joins in this morning. Hugh, what's going on? We do know that in the 1920s, you had the Great Depression on back of trade wars. And if anybody is reading the headlines this morning, I would imagine one should be extremely nervous of what we are staring at.
Well, it's clear that markets are extremely nervous, and it's pretty ugly out there, sitting here in Hong Kong looking at nothing but red numbers. At the same time, I think this will probably prove to be a market overreaction. This is, after all, not the 1920s. And we have a situation in which the global interconnections, the global links, and in particular between China and the United States are such that there is no way of untangling them and for the two nations to get into a major trade war. I do not believe that will happen. I think this is a move very much like what Trump did with the aluminum and steel tariffs. It's an exciting posture. Trump wants the trade deficit between the United States and China to be reduced by $100 billion. Wilbur Ross, his trade representative, has said the same thing. That's relatively easily done. China has to just start importing significant amounts of liquid natural gas, for example. And the second thing that Trump wants is for U.S. intellectual property to be better protected. And
I get your point.
While this may moves in that direction.
Right. So while this may not be the 1920s, and of course it's very obvious that the world is not decoupled as we speak, but we do agree that if the U.S. is going to do what they are claiming to do, of course initiation is what we stand at right now, it's going to be no surprise that China is going to, of course, retaliate. Their statement from the embassy very clearly said that they will fight to the end against the trade war if that's what the U.S. wants at this point of time. What I want to understand from you is, do you fear that this is going to lead to a tit-for-tat war, and that is going to be bad news because at the end of the day, this is going to do no good to anybody?
Well, as I just said, I don't believe it will lead to that. I think what it will lead to is a situation in which China and the U.S. in particular will find ways to actually accommodate each other's requirements. The United States wants to build back its trade deficit. It's been, running huge amounts of dollars for decades, right? And Trump wants to change that. I think that's a legitimate concern. It is also necessary for China to, actually protect intellectual property of people who invest in mainland China. That's a necessary thing to do. We saw that the Broadcom-Qualcomm deal was nixed recently because of IP and national security concerns. China will have to realize that it actually has to make some changes in its trade stance and in its stance with regard to intellectual property. I think this will be in everybody's best interest. I think there will be a negotiation, not a war. I don't think it will be a tit-for-tat. I think markets are nervous, but this is not the big one, so to speak.
So would it be fair to assume that last couple of weeks ago when you had those tariffs being talked about against aluminium, it was just again negotiation that the U.S. was looking at. It's not just China, right, and I think that is the very point. I still remember that you had European markets reacting to the fact, saying that, you know, we buy from your beer to your motorbike in the U.S., and eventually, if this is going to continue, they are going to slam back with hikes in tax or sort of trade tariffs that would come in. He's not just warned against China. His actions currently are, yes, focused on China. He's talked about India as well just a few days ago, where he said that it's unfair in terms of the kind of discounts or, you know, sort of impetus Indian exporters get back home. So clearly this isn't about the U.S. and China. This is about America versus the rest of the world. And we've seen how the U.S. operates. I do get a protectionist stand. I do get about make in America, sell in America. Sure, those are very sort of noble thoughts that Trump has. But my only fear is that the global equity markets are tanking. Sure, there may not be any retaliation. It'll be negotiation. The world will be a happier place tomorrow. But from the way things are going, gold seems to be rising. The U.S. LIBOR seems to be jumping up over the last 30-odd sessions. The dollar is looking at some weakness, and global equity markets are tanking. I mean, if you need any more signs, what would it be for you to take profits off the table then?
Well, I'll just remind you, for example, the steel and aluminum tariffs were initially primarily going to hit Mexico and Canada, right, who are the major exporters to the United States of those products. That issue is, you know, no longer on the table because the NAFTA renegotiation that Trump wanted has proceeded very well. And we will probably have a new NAFTA agreement in North America in the very near future. With that, any kind of tariffs with regard to Mexico and Canada are gone. It was the first move in a negotiation, and that negotiation speeded up in response to it, and that's what's happening. If you look at it globally in terms of freedom of markets, United States tariffs on anything across the board are lower than any tariffs anywhere in the world. That is a fact. You know, that is a fact. As you know, the Indian economy, the Chinese economy, many other economies in Europe are very, you know, much protected behind high tariff walls, and they are also, you know, actually not doing much about that. So Trump is the kind of person, and he's, you know, I think it's very important to keep that in mind. He is not interested in creating a trade war. Why would he? He is interested in getting results. And these results, I believe, will be forthcoming. Wilbur Ross said yesterday, immediately after the Trump announcement, that China could easily help reduce the trade deficit by $100 billion by significant imports of liquid natural gas. China does, in fact, want to do that. So let's speed it up and get it going and get some agreements. I think that's what's happening. I'd like to point out one other thing in terms of the relationship between Trump and China. That's North Korea. There's no way in which Trump can expect China to be helpful on the North Korea issue, which he does want to resolve, if indeed the United States and China end up in a big tit-for-tat that ruins world markets. That's not going to happen. I do not see that happening.
I mean, I'm glad you're looking at the glass as half full versus half empty. I mean, we're looking for some hope this morning. But very lastly, if that is the assumption and Mr. Trump has very noble thoughts and the world will be a better place sooner than later, would you use today's opportunity to buy into equities? Because again, if everything's going to look great, stocks coming in cheap is what we like.
Well, look, we've had stretched valuations of equities globally since at least you know, the period of last November. Then we had a pullback in December, and then we had another run-up until very recently with a few bumps. I think we will see a continuing correction at this point. So it may. You know, if you're asking me, would I start buying stocks today? Yes, we would be buying certain select issues in China in particular. because there are a number of, sort of across-the-board hits being delivered to financials in China, for example, that don't seem to be at all justified because we're looking at global increases in interest rates. And this is going to be good for financials, for big banks, for insurance companies, and so on and so forth. There are also a lot of Chinese, big counters that are essentially not going to suffer one way or another from any kind of tariffs imposed. Manufacturers will suffer, but, for example, service outfits will not. India, I think, does not have to fear very much from this at all. There's nothing much that Trump is going to slap tariffs on when it comes to India, because the amount of exports from India to the United States itself is not a huge element in the Indian economy. So, yes, I see buying opportunities. I would not buy indexes at this point, but I would buy selected counters.
Right, thanks, you. Of course, good luck with today. It's going to be a difficult Friday, but I guess we can't wait for the weekend to be here. Well, we have with us Peter McGuire, an expert in what's going on across the currency markets and commodities, joining us. Peter, this is turning out to be uglier than initially anticipated. Not sure what Trump is thinking or not sure what his thought process here is, but I mean, he's starting a war which is not really required at this point of time, right? I mean, he just seems to be aggravating other nations. China is not the one to keep quiet about any sort of trade war initiated against him. And they've said that very categorically in their letter from the embassy, where they said they will fight till the end of time against a trade war if that's what the U.S. wants. Do you think this is one of many trade actions to come our way in the near term at least?
Well, good morning, Selena. I do think so. We're 14 months into the term of the presidency. It was quite a simple mandate that he put forward to his electors, or in his electioneering campaign, was that he was going to attack tariffs. And now we're 14 months in. We've got the best part of 2.5 years left for the run of the presidency, and he is that style of negotiator. He doesn't take things on lightly. He takes his gloves off and certainly hits hard, and I think it's drawn the normal response that you would expect from China. They're the same sort of negotiator, and this is just interesting to watch first and second world powers battle it out. I think there's going to be an extended period. I'm not sure how it's going to end, but he certainly gets results, President Trump. I've got to say that. He gets people talking.
Right. MSCI's China exposure to the U.S. Is fairly limited, I know, but I believe 50% of exports, or rather steel and aluminium, after his recent tariff war on the metal space is expected to be impacted. And I know a number of countries are also exempt, but we're looking at least 50% of exports being hit. What does that really mean, Peter, for commodities? We were in the thick of a bull run. Commodity prices were looking good. Demand worldwide was picking up because growth, of course, was looking well placed. All those dynamics now stand changed, do you think, Peter?
Well, to some extent they have. They've had a fairly nice run-up, as you've mentioned. Going back over the last 2 years, it's been one-way traffic for a lot of these base metals. Certainly there's been they're off at the moment from their highs they experienced over the last few months. Copper's down from $3.30 to about $3 a pound. But well up when you put your mind back to $2 a pound that we saw over in 15-16 period. So I think it's a wait and see. We've just it's very difficult to forecast what presidents are going to do and leaders of nations. But one thing for sure, I think that volatility aspect is certainly back in the market. If the Dow's down 700, Selena, that really creates a lot of angst for traders. We see, Tokyo and all the other markets, China and so on, really hit hard. It'll be interesting to see what happens in India this morning. And Asia's been hit. It'll be interesting what happens in Europe later today and, of course, the Middle East. So all of those factors at play create, I think, a level of fear to traders. And that's one thing that they really, retail traders are very, very mindful of. If they play with leverage, they've got to be very careful in their portfolios.
Right. Peter, so, I mean, and this is extremely tough spot to be in, but I just want to try and get some more perspective from you. Another aspect that has been drawing my attention. Since the 7th of February, the LIBOR has been consistently rising. In fact, I think it stands at about 2.271, and it's gained for the last 31 trading sessions. This is the highest level on the LIBOR since 2008. Meanwhile, the gap over risk-free assets, also which is the LIBOR OIS spread, has more than doubled since the end of January to 55.6. Again, these are levels unseen since 2009. Are these numbers, is the screen telling us, or rather know something more than what we already know, Peter? And of course, these are signs that if the curve does get inverted, the last time it did was in 2008. So are we staring at a big fall? It's not just going to be a near-term sort of reaction to anticipated trade wars between two big nations?
Well, look, I know where you're drawing this argument from, and I can appreciate that. And I tell you, they're big. We all understand what happened in 08 and 09. No one knows better than I when you saw those huge washouts in each night. But the reality of the matter is, I think fundamentally we've got strong economic growth. We've had quantitative easing. We've got low interest rates, and I think governments are far more centred that if they need to create stimulus, they will do that. There's no ifs, buts or maybes. We had a rate rise this week. There's still a lot of uncertainty. President Trump's not going to back down in the short term, and I think it's just going to be a wait-and-see approach over the next couple of weeks post-Easter where this particular tariff situation is taking it, and, of course, where the LIBOR plays. So, again, Samina, I think it's just volatility, and that affects all markets from currencies, commodities, and, of course, equities and bond rates.
Right. Peter, what's the call on the US dollar and gold? I mean, gold very quietly has been gradually moving up over the last couple of days. I believe it could be risk safe haven buying that we are seeing in gold. The dollar, on the other hand, has also declined and is under some pressure this morning. Your view on the dollar index and hence on the dollar-rupee pair as well, because here you have a weak dollar and a weak rupee, not sure who's going to win. And also your view on gold. Is it a good time to start buying some gold?
Well, I think, if you look at gold first off, it's had a wonderful run probably over the last, what are we looking at, since about Christmas. It's been well up and well bid up. It's been volatile and choppy in the latter part of January, February and March, and it's just whipsawing between that, 1320 to 1345 sort of number. As far as US dollar index, you might see a little bit further weakness there. I would have thought that it possibly wouldn't be as wild as what we've seen in the last, 24 hours. But I tell you, when you've got these announcements coming from President Trump, then that creates a little bit more uncertainty, which in turn creates, again, that volatility side. So you might see the index trade, maybe that 88.5 to 91 sort of level. I think it's just going to be a very, very wild, in the sense of volatility side. There could be further softness, but I feel as though that, it's sitting at that 89.5 at the market. There might be a little bit further downside. And as far as US rupee pair, I feel as though that'll fairly much stay range bound, Samina. It just seems to be tracked between those, 63.5 to say 66. Unless something dramatic happens, it's just a wait and see.
Lastly, Peter, what's the trade on commodities this morning? Any commodities you could sort of look at shorting? Or, of course, would you look at buying any of these metals if there is a meltdown today?
I think you've got to keep an eye on copper. That's one that really shows a little bit of a market, forecaster. That's always good to keep a very close eye on from your trader's perspective. Keep an eye on oil as well, WTI and Brent. There's, it's been bid up, and it's, whilst you've got the markets off, you've got, the best part of nearly $1 on WTI and $1 on Brent this morning. So they've had quite nice upticks, and it's been a very, very strong market. Maybe that's one that traders need to be, just having a close eye on, and certainly keep an eye on gold. It's up $11 in the morning session in Asia. So it's been a very strong morning. Silver's up similar. So from a trading perspective, just, whatever you're trading, Samina, make sure that they've locked their positions in tightly and looking at their stop losses.